Good afternoon, everybody. Welcome to TraderMerlin Show for your Trivia Taco Tuesday. I like to look at it here. It's Information Tuesday. As most of you know, I try to, tailor the content on this program to what you guys want. Of course, I have my own way of trading and investing, but I like to share some of those ideas. A lot of times, we dive backwards a little bit and go into some of the more elementary things, discussing kind of fundamentals and how markets work. So that's kind of what we're going to talk about today. Today's discussion is all you ever want. Oh man, I can't even spell it right. Man, see, this is what happens when I'm scrambling. It should be all you ever wanted to know about ETFs. I look like an idiot, but this is what happens when you're scrambling to get presentations done very, very quickly. This was spurred because of Chio. I believe it was Chio asked, could you do a show on ETFs? I thought, okay, let's do one because they are probably one of the most utilized, revolutionary, and perfect instruments to be trading. Now, before we go into that, a nice shout out to all of you who sent in messages. I got some nice messages from you based on my show yesterday where I wanted to dispel some of the, misconception that I am extremely politically biased, because I am not. So thank you guys for that one, and we'll try to keep that discussion to a minimum, just because I know it will ruffle some people's feathers if I even say one party's name. They go, oh, don't let that happen. Okay. So Lisa says, does the gingerbread man have anything to do with the stream tonight? No, it has, no, I don't even want to tell you what it has something to do with. It has something to do with a conversation, a Zoom meeting I was on earlier today, and if you didn't see the bottom of it, I should show that one to you. It's just gingerbread man says, bite me on it. Yeah, that was my attitude today. It's the way I felt about it. All right, well, thank you guys. I'm a little bit early for the holiday spirit, but it was a subtle jab to somebody I was on a call with today. But anyway, let's get on with our topic about ETFs. So, to begin with, we have to understand very clearly that this financial machine, and this is going to come across, I think a lot of you are going to resist this one and maybe look down upon this comment, but I believe this to be true. I believe that the entire financial system, by architecture design, is built to make financial companies more money, period. Now, I know some of you are going to go, well, Merlin, it's there because we need a way to invest in these markets and grow our wealth and make more money. Yeah. That's an afterthought. Basically, what happened is you have a system of traders, and this isn't just U.S. markets. This is international markets around the world. Systems of financial firms that are literally going, okay, what new product can we release? And if it's a brand new product, we can charge a whole lot more money for it because nobody else has it. And then as it becomes more competitive, they can lower their prices. But bottom line is they are trying to fleece you and me for as much money as humanly possible while they can, period. You cannot argue with me this point, because you look at the monolithic, 200-story buildings that are built for financial firms, yet the consumers that are using those products are driving around in Honda Accords and not the fancy vehicles, because typically those financial firms are making money. So that all to say, to start this discussion, exchange-traded funds are an evolution of a long series of products. The first one, or the main one really, that opened the doorway to better investing. It all started with individual securities, right? You could buy a share of, GE, you could buy a share of WorldCom, whatever. You could buy all of those individual companies, but you had to go through a broker. The broker charged you a ridiculous amount of commission. I remember my dad talking about $250 transaction fees to trade through Merrill Lynch like in the 80s. Insane. Now transaction fees are free. Why? Because they're making money elsewhere. So it went from individual stocks, and institutions made a ton of money. But then there was this, hey, build a portfolio. You should build a portfolio and diversify your holdings, which you should to protect yourself from a risk management perspective. But then they came out with mutual funds. And mutual funds, all they were was a way to take a bunch of different companies, put them into a portfolio so you don't have to go buy each individual component. So let me show you what I mean by that. Let's go to this chart here. So this is a chart of the Dow Jones Industrial Average, right? This is the DJI or INDU. So in essence, this represents a specific amount of securities. Now, for all of you that know the markets, you know that the Dow is 30 different components. Now, if we look at this graphic here, actually, I think a couple of these may have changed. This is an old graphic I just kind of pulled up, but these would be, for maybe take one or two out of here, the 30 Dow components. I know some of you are going to be like, wait a minute, that one's not in there anymore. Don't worry, I'm going to just leave it there for now. if you wanted to go and build a diversified portfolio, you could go and buy, 2 shares of JP Morgan and 3 shares of Goldman and 15 shares of Coca-Cola and build your portfolio, but just think of all the different transaction fees you would incur by buying each one of these different components. It's a pain in the butt. You wouldn't want to do that. So what they did is they came out with mutual funds that represent this. And this group right here, this 30 different components, that might be the Vanguard large cap value fund, and there's hundreds, if not thousands, of mutual funds out there trying to do the same thing. They're literally building a portfolio that mimics these holdings. So let's say it's these 30 holdings right here. Now, the way that a mutual fund works is they get you with fees. For those that aren't familiar, there are 2 load fees you have to pay attention to. One's called a front end load. The other one's called a back end load. What a front end load means is when you buy this security, you have to pay a percentage up front. So let's say it has a 5% front end load fee. That means if you were to buy $100,000 worth of this mutual fund, you'd have to pay $5,000 just to have the privilege to buy into that thing. Ridiculous. So a front end is you pay up front. A back end load is where when you sell it, they charge you that percentage. Oh, but wait, there's more. With mutual funds, they also charge you, administration expenses, right? Expense ratio is what they'll call it. And this includes marketing fees and all sorts of other fees. That ranges anywhere between 0.5% to 3 or 4%. I mean, these fees can be really, really high. Most I've seen lately is about 1.5% for an expense ratio. But just imagine now, you bought this mutual fund, you think you're diversified, but you have to be, getting 6.5% rate of return just to beat the average that you've already paid in your fees. It's crazy. So what the ETFs did is said, well, we don't necessarily need to have a mutual fund that has a whole team of investors. I mean, this is pretty public knowledge what these Dow 30 components are, so we can automatically do that. So what they did is they created this thing called the diamonds. So this is just the nickname it was given. And they've taken those 30 companies and they put them into one simple share for you. It's exactly like a mutual fund. However, it's all done automated. There's no need for a whole management team there. Therefore, the fees are much, much, much cheaper. Lisa says, I met a guy whose job it was to figure out ways to charge people for things and late fees. Oh, God, what a horrible job. Knowing your job is to find ways to take money from people, man, that's a tough one. Yeah, you said you met a guy. I hope you didn't marry him. Hope you didn't marry him, Lisa. Judah Brand's favorite trading strategy? Oh, that's good. Need to know the basics. That was sweet. Yeah, anyway. So this basket of securities, now this exchange-traded fund, is something that can be traded on the stock exchange just like a stock. So it can trade during regular market hours. You can buy it and sell it as much as you want. There's really no other rules to it. With a mutual fund, remember, you can only sell at the end of the day. So here's a big distinction between these two things. Let's say you bought a mutual fund in one account and you bought an ETF in the other, and they both represent the same thing, right? So let's say it's a mutual fund, the Fidelity Large Cap Value Fund, which would be like a Dow 30, and then the ETF right here, which is DIA. That's the Diamonds, Dow Jones Industrial Average. Same thing, different format. So the market's open. Let's say we've got a $10,000 worth of each one. And all of a sudden you get just some horrific news where you're like, I want to get out immediately. Oh my gosh, this market's going to go south so bad. And you go to sell your mutual fund. You go to the exchanges, you hit the sell button on both of those accounts. Your ETF will be executed instantly. If you do a market order, it's going to be executed immediately and you're out. And let's say over the course of that day, we lock limit down, lock limit down, lock limit down, market's down 21% on the day because it hit all the lock limit downs. Insane, right? Your Dow, those mutual funds, will not sell until the end of the day. It's called net asset value. They do not trade at all during the day. And I believe I can give you a chart here. Briefly, let me look up one. VCINX. Now, it's not even DRBNX. I don't know any mutual funds. I don't trade them anymore. JAOLX. Maybe this doesn't give me mutual funds. It might not give me mutual funds on this platform. But bottom line, a mutual fund chart's can look like a lot of little dashes because it's just one price at the end of the day. It's called the net asset value. So that's a huge disadvantage to mutual funds and a big advantage to ETFs. I can trade them whenever I want. The fees are also a major part of it. So let me walk you through a little bit of basic elementary stuff here for exchange traded funds. These are some of the oldest and best known. So I have the start date out here and what they are. These are other major market indexes. So the S&P, the Dow, the NASDAQ, the Russell. You know, I look at these every single day. Absolutely every day. There's not a day that goes by where I have not looked at, well, let me take that back. That's not true. I don't really care about the Dow, so I don't typically look at the diamonds. Yep. Jimmy brings up another great point. That is a fantastic point, Jimmy. Thanks, because I did not have that in this presentation, but you're right. ETFs, you can trade options on them. Now, not all of them, but these ones here, these are the big daddies. These are very liquid market indexes like the S&P 500, the Dow, the NASDAQ, the Russell. These all have adequate liquidity. So yes, you can trade options, whether that's weekly, quarterly, maybe even monthlies, or monthly, maybe even weeklies. There's generally plenty of liquidity on these. Mutual funds, you cannot trade options on them. So take a step back and think pros and cons here. If you have a 401k, your fund provider typically gives you just mutual funds. So you're kind of stuck in mutual funds. However, if you could maybe do a self-directed IRA and just move your IRA over to somebody like Charles Schwab or E-Trade, instead of buying a large cap value ETF, or instead of buying a large cap value mutual fund, which is higher in fees and you can't trade it all the time and has no options, you buy DIA, which will be the same thing, but now you can trade it when you want, and you can also sell options against it, potentially increasing your rate of return in your retirement accounts. To me, that is a massive advantage for ETFs versus mutual funds. So these are just some of the bigger names, and again, I look at these every single day. I don't look at the Dow, but S&P, NASDAQ, and Russell is a daily affair for me, absolutely every single day. So let's just look at a comparison or a composition here. If we look at the S&P 500, which in my mind, for me, my perspective is this is the market, is the S&P 500. It's broken into several different primary categories. And there's actually one that's missing on here, and I'll get to that in a second. But you have financials, information technology, healthcare, consumer discretionary, industrials, energy, consumer staples, telecommunication services, utilities, materials, and it says unassigned. But another one in here would be real estate that I would like to add to this list. We could go and build up, let's say you're really hot on financials. Well, I could go find a mutual fund that focuses on financials, but why would I do that? I could simply go out here and buy ETFs, and I put all the different ticker symbols there next to it. So for those of you who might be new, you could click on or type in those symbols, and now you would have access to a specific portfolio of instruments, all tailored to that specific subsector of the S&P 500. Tom says, look at the heat map for the S&P, NASDAQ, and Dow, and look at the manipulated 7 dominate. Then go and see how much the Magnificent 7 is institutionally held. Yes, that's a little bit of a tangent to what we're discussing today, but yes, it is completely manipulated, and that is what's driving, we know that, right? We know that's what's driving the market. I guess what I'm looking for is what's that next piece that's going to be added to or taken out of that Magnificent 7. It always seems like there's a rotation that goes on in these markets. So that gives you guys a real quick breakdown, and you can take a screenshot if you want. Most of you probably know this. I have a watch list over here on my screen that I have exactly that. So you guys know when I talk about my 1% strategy, you have, here's the IWM, here's financials, here's healthcare, here's industrial. So I look at these market segments to look for, maybe an options play or a trend potential play for those specific market segments. And I think that that's a great resource for anybody here who's looking at longer term investing. And as Margaret says, it says no earnings risk with these. I can't say none, but you're significantly reducing, right? So if we have, the Dow Jones Industrial Average and the heaviest component, the Dow drops 99%, the Dow's going to take a hit, right? But you do have diversification there, and that's one of the key points of diversification is spreading around something called diversifiable risk. With something like the S&P 500, right now there's 503 different symbols in this one. If any one of those has a horrific day and is down 30, 40, 50%, it's probably not going to cause too much of an impact unless it's Apple, Microsoft, those are your two biggies, and maybe Nvidia, right? Those are now all of a sudden becoming a little bit overweighted in those indexes, but still, you're right, Margaret, you shouldn't be feel too concerned for earnings. I typically use IYR for real estate. Each time you buy SPY, most of the money goes for the Magnificent 7. That's not totally true. So here, I'll show you that right now. Let's go You go to bar chart. Oops, not bar charty. Yes, a majority goes to it, but it's not as bad as some indexes. Let's just go SPY. And again, for anybody who ever would like to buy into an ETF, you simply go to something like bar chart, and you can just type in whatever your symbol you want to look at. You scroll down here, and you see it says constituents, and then it'll give you the breakdown of what it is. So, right now, 7% Microsoft, we'll call 7% Apple, 6.27% NVIDIA. So really, these top three are getting close to 21% of the overall index. But it's not most of the money. It certainly means that they're more heavily weighted, but I wouldn't say that most of the money goes to them. Remember, there's 503 components. Of course, if you scroll all the way down here and go to the very end, you have some components like Net Appliances and Hewlett-Packard Enterprises, 0.06%. That's like the minimum you can get, apparently, because that seems to be the lowest number for a lot of different companies. So yes, it definitely is skewed to a couple companies, but it's not like 30, 40, 50%. Now, some of these other indexes are a bit worse. So for example, I'm looking at this one here, and I can see that Microsoft is by far the heaviest, well, not by far, but Microsoft and Apple are the heaviest components. If we were to shift this over to triple Qs, which is NASDAQ 100, you would see a different picture. It's even more heavily concentrated at the top three, with Apple, Microsoft, and NVIDIA commanding, it looks to be about 28%, maybe 29% of the overall index. So this is partially due to the fact that the NASDAQ 100 only has 100 securities, and the S&P has 503. Now, what if we look at the DIA? You're like, well, there's fewer. There's only 30. Yeah, but it also removes a lot of these components. Did it not take it? DIA. My computer's acting wonky for some reason. Here we go. So with diamonds, overall, you're going to get higher concentrations on pretty much everything, right? Because you have fewer components. But notice you don't have Microsoft at number one here. It's United Health Group. This is a price-weighted index, so it's a little bit different. But United Health Group is at 9.2. Goldman Sachs is at 7.9. Microsoft at 7.13. So a little bit heavier concentrations here, but it's also more spread out, unless you look at something like Intel, which is only 0.54%. Lisa says SPY is designed to go up, hence rotating out underperforming stocks and replacing them with high-performing stocks. Yes, and that's pretty much the same for all these indexes. I made this comment many times, and it was interesting. I actually had a student come back and said, man, one thing that you said that I never knew, never heard, never even understood was that markets are designed to go up over time. They're literally built. And I'm not talking a company, but an index like the S&P, the NASDAQ, the Dow, the Russell. They are architecturally built to go up over time because, like a professional sports team, certain players on that team are going to get old and underperform or just not be in favor anymore. So right now, I would imagine the S&P and other indexes are looking at getting more AI in there. Right? Bring more of that because that's the hot topic. Let's get that. That'll boost. And then, 5 years down the road, it'll be something else. Maybe it'll be some other robotics company that comes out of nowhere and starts to dominate. Yes, rotate out with the old, in with the new. They're built to go up over time. Absolutely so. Tom says, yes, it's a tangent, but explains why the big firms gave up on mutual funds and now push ETFs, easy to manipulate. Well, that's not why they gave up on it. Where they gave up on it is the audiences understood that mutual funds are not a scam. They're not a scam. They're a sucker play that we didn't have a choice. But now through education and programs like this where people go, oh, I didn't know that. Now all of a sudden these different ETFs get very popular. They're much cheaper. They're much more liquid. They're easier to use. You can get options. If you got them side by side, it's like, why would I want a mutual fund? And they realize from a firm's perspective, if I'm Fidelity, typically I have to have a team to run a mutual fund, right? Because they're out there picking the different securities. Forget it. Just track an index, right? Build something and just stick with it and keep it very, very simple is a much easier approach. So ETFs, I think in a few years, mutual funds will just disappear altogether. There really is no purpose in my mind for them. Right now, the only people who are still using mutual funds on a regular basis are those of you who have a 401k with your company because they are still convinced and somehow being sold on the idea that they need to put you in mutual funds. Honestly, if anybody here has some financial backing and connections, I'm telling you, you could open a 401k, be a 401k provider, and go out there to all these different companies and just your first day with their HR department would be, okay, what's your current 401k plan? And they'll show you and see all these mutual funds in there and say, look, you realize that those mutual funds are hurting your employees. They're paying far more money. I can get you down to 1/4 of the cost, maybe 1/10 of the cost, which passes the savings on to your employees. And it's the same investment vehicles. They're actually more flexible. And you'll probably get those accounts. And I would imagine you do fairly well because almost everybody I know still is stuck in mutual funds in a company 401k. It's a legacy system. Maybe we'll see that update in a different world. All right. So let's look at some of the pros and cons of this. I don't know why I've got all kinds of little typos on here. Sorry, again, I was rushing to get this done and I didn't even see Chio here today. Chio, this was for you, and you're not even here today. Let me make sure I don't go too long on this. All right. So if we look at these side by side, what are some of the pros and cons? ETFs, they're very diversified. So are mutual funds, right? The universe of mutual funds, there are a lot to choose from. Can you short a mutual fund? No, you cannot short a mutual fund, but you can short ETFs. Can you trade them intraday? Yes, you can on an ETF. You cannot on a mutual fund. Sales fees, no. There is no sales fee on ETFs. There is on mutual funds, and you're starting to see the mutual fund companies actually drop those sales fees because they realize that people are onto them and the gig is up. Other fees, typically mutual funds, are very high, and I'm going to show you some examples here in just a second. So this is an old example, but I just wanted to show you this one. I'll go through it quickly. So this is one, it was the IFOAX Technology Mutual Fund. And then on the right-hand side, I have XLK, which is an ETF that represents technology. So the mutual fund has 53 holdings, the ETF has 67, so ETF a bit more diversified as a number of holdings, but a bit more concentrated, Microsoft and Nvidia as well. However, you notice there's a lot of repeated symbols in here. So you've got Amazon on this side, which is not on the technology side. You've got Microsoft, which is on both. You have Apple on both. Alibaba, no. You have Alphabet, yes. Where's Alphabet? Oh, yeah. So they're not that close. But, it was a bad example. I'll show you a different example here in a second. The reason I brought this one up is because when I took this example, this is a couple years old, of IFOAX, it kind of shocked me that IFOAX had a 5.5% front-end load. Right? That means that I'll show you in a second, and they also had a 1.28% expense ratio. So if you bought $100,000, you have to pay $5,500 up front because it's a front-end load. And number two is the expense ratio. Now you're paying this every year. If the market goes up 10%, doesn't matter, you're paying this 1.28%. If the market goes down 30%, you're still paying that expense ratio. It does not matter. On the ETF side, you have a management fee of 0.1%. So if you bought $100,000, you're paying $100 annually. I know that may not seem like that big of a deal, but if you're saving yourself over $1,000 a year to be in something that replicates pretty much the same performance numbers, why aren't you doing it? Here's a different one. I took this one today, so this is more updated. And this is the VALIC. This is another technology mutual fund. And again, XLK. Notice the one on the left it looks better because it has 101 holdings. And the other one has 67 holdings. All right, fine. Well, if we look at those numbers side by side, the new mutual funds, most don't do front-end loads or back-end loads anymore because they know no one's going to buy them. But you have a 0.44% expense ratio, which means you're looking at about $440 annually, and the other one is giving you a 0.1%, which is $100. So while it's not a monster savings, it is saving you about $340 per year with these two funds that are alive and well today. Could you pick a different technology fund that doesn't give you as much exposure to Microsoft and Nvidia? Sure, you absolutely could, but this is just what I wanted to give you as a very basic example of the fee structure. But look at the performance. So I put these two side by side, and part of the reason you're seeing this separation is also the fees being taken out of it. But the VCNIX, which is that mutual fund for technology, since July of 2021 is up 35.85%. But XLK, which is an ETF, which has far lower fees, is up 52.65%. Now, I know what Tom's going to say. Tom's going to go upset and go, but they're different. Microsoft and Nvidia were the top two holdings in there, and therefore that's why it's pulling ahead. And while you are right on that one, Tom, overall, if you have even the exact same components in both of these, 100% identical components, XLK would win because the fees are lower, period. All right. Just wanted to get you before you started typing that one in, Tom. I know Tom's over there on his keyboard going, but. I know where you're going to go, Tom. We had a financial advisor who would keep buying mutual funds in our IRA. I know. Guys, let me tell you where it all started for me. And when I was in college, I wanted to be a financial advisor. I really wanted to be a financial advisor. The thought of taking money and growing it for people and helping them achieve their financial dreams, including me achieving mine because I'll be managing my money, was, I don't know, I felt like that's kind of the highest level of giving back. Making people achieve their financial, or helping people achieve their financial dreams, to me is, how much more rewarding is that? Teaching them a skill set's one thing, but assisting them on that path to financial freedom to me is one of the most rewarding things. So I worked for this financial planning firm, and this financial planning firm, I had worked with some great people, except the guy who ran it. He was a total jerk. I couldn't stand the guy. Just treated everybody like dirt. But anyway, the way it works is like this. So for those of you that have a financial advisor, it's probably something similar to this. At the time I was an intern, I was excellent with Excel. I was a very good math person. So during my internship, I would literally be put in this broom closet with a computer, and my boss would come to me and say, here's a stack of all my clients' investments. Make sure you don't get anything lost, confused, but I want you to organize them by asset class. So it was like by stocks, I had options, futures, you name it, everything, and broke it down by category. And at the end, once I had all the spreadsheets done, I would bring it back to my boss, and my boss would say, without fail, we're going to sell all of this, and we're going to put you in these funds that'll help you. They had a formula, it's easy. You just put in a pie chart. Here's what you're going to get. But everything in that pie chart was a mutual fund, and it was from Neuberger Berman. It was one of the big firms back then. Come to realize that my firm was being kicked back money by Neuberger Berman for putting these customers in these funds. And we're not talking customers that had like $50,000 or $100,000. I was in Marin County with customers that had tens of millions. So all of a sudden, one of these customers got a $10 million account, and we put him in a front-end load mutual fund that's charging him 5.5% up front plus a 1.28% annual fee. And my boss would get a 1% or 2% kickback from that load fee. If this is a lose-lose for the customer, it just drove me nuts. And I couldn't, I don't know, I guess I just got disgusted understanding that it's more about the financial advisor firm making money and then the mutual fund company making money rather than the customer, the end user, who honestly is looking at these people with open eyes like, help me. I found that to be I would almost say fraudulent. I didn't like that at all. Let's see. My father's broker would put him in mutual funds of the brokerage that he worked for. Correct. Yeah. When you work for, let's say you work for Fidelity, you're not pushing, Oppenheimer funds. You're not pushing JP Morgan funds. You're pushing Fidelity funds. Of course you're pushing your own funds. Absolutely. Let's see. Wasn't thinking that. I was thinking about going through Fidelity's mutual fund printed list back in the early 90s and focusing on funds that consistently got 20% over 1, 2, and 5 years. So what Tom's talking about is, when you're looking at review analysis and trying to find performance numbers, that's one of the criteria is go back and look at a historical track record of, 1, 5, 10, 20 years. And a lot of these mutual funds didn't have 20-year worth of experience. Fidelity, Magellan, of course, one of the biggest out there did. But nowadays, I'm telling you, every single mutual fund that is out there can be replicated with one or more ETFs combined. You can build your own, and you have far less fees in that process. Okay, so we've already talked about some of the pros and cons. Let me run through real quick just so I can get these out of the way, and then we can do more discussion, look at some price charts as well, and I'll show you more indexes here. Allows for instant diversification, right? That's the same as a mutual fund. There's no single stock risk, which is what Margaret pointed out earlier. So if you're worried about, the earnings numbers coming out, which we'll discuss here in just a minute, that can obviously have a pretty significant impact on price. Tesla feeling it in the after-hours session. If you aren't, concerned about that, I think you have a lot less stress if you are sitting there in a position where you have very diversified holdings. Great. Obviously, today you have Tesla and you had Google report after market, and those are both down. Most likely that's going to lead to a downward pull on our equity markets tomorrow. They are much cheaper than mutual funds across the board. Absolutely. Trade in and out like stocks. Okay, so I can do them during the day. I can even do them in the after-hour session if there's liquidity in those markets. So I can trade SPY before 6:30 in the morning California time. The cons, you're paying commissions on each transaction. And that, that I guess it is a con, but nowadays you might not pay commissions on each transaction. It really depends on which brokerage firm you're using, because some brokerage firms don't charge commissions anymore, which I think is a great thing. And we had a couple more little items here. You have no voting rights. So you might hold shares of Microsoft inside that ETF. You have 0 voting rights. You will not be allowed to vote. You don't get those voting rights. You do get dividends though. And I put here as one of the cons, many of these ETFs are illiquid. So before you run out there and say, hey, ETFs are amazing, I'm converting everything over to this one or that one, always check the volume on it. My go-to number is about 2 million shares per day. Anything less than that, I'll just move on. I'll find something else. There's always going to be a leader in each market segment for ETFs. So what are some of those symbols? Let me show you here, just to show you the scope. The reason I like them is it allows you to get into anything, just about anything. So some of you might be looking at emerging markets. Great, EEM. You can get Japan, Brazil, China, Singapore, Taiwan, Switzerland. These are ETFs built for a specific market. Again, watch the liquidity on these ones, but you can now, if you thought that for some reason Malaysia was going to be just doing, that's a great question, Andres. I'll get to that in just a second. If you thought that Malaysia was going to be the next great place, awesome. Then you could buy EWM and hold that for a while and, maybe benefit from their rise as an economy. You had commodities. We've talked about oil, natural gas, silver, gold. You got diversified ones like DBA or JJG, which is going to be grains. Again, liquidity on some of these can be pretty bad, but you can find targeted agricultural commodity ETFs, metals, etc. You have currencies: euro, Australian dollar, British pound, Japanese yen, Canadian dollar. I mean, this is another great resource for you, particularly those of you who want to go look at currencies in different markets, and parking your assets in a currency and benefiting from the up and down moves of that currency. So Andre says, what does the tokenization of ETFs mean? Well, I think what a token is, so first off, let me need an ETF that is Saudi Aramco. There might actually be one, Oliver. There might actually be a Saudi Aramco or just a Saudi Arabia ETF. Again, anybody can create an ETF. Right, so I could go out there right now and I could create a token, right? So this is where we start to bridge traditional assets versus digital assets. I'm not sure off the top of my head if there is a Saudi Arabia exchange-traded fund. But what I could do is I could create one. There are a lot of different marketplaces that you can create financial instruments. And I could create a token. And that token is comprised of the value of Saudi Aramco, and I could pick maybe the top 10 businesses in Saudi Arabia, or maybe even just do Saudi Aramco and have it pegged to the share price of Saudi Aramco, and now that token could be traded based off the valuations of Saudi Aramco. That's where tokenization is taking it, and I guess to answer your question a little more deeper, what does it mean? With tokenization, what you're allowing is greater reach for everybody. So, for example, in the United States, all those different ticker symbols I just showed you give you and I the ability to trade and invest in those ETFs because they're US-based. In other parts of the world, they may not be allowed to trade US exchanges, right? So let's say you're in Italy and you're only allowed to trade Borsa Italiana, or now you have to go international, create an international account to trade American markets. If you went into something like a decentralized exchange, Uniswap, SushiSwap, PancakeSwap, at some point, we'll have these decentralized exchanges which will allow one person to open one account and trade any instrument in any marketplace in any part of the world. We're not there yet because, of course, there's going to be regulatory problems, and I think that you're going to get a lot of pushback from New York Stock Exchange. You're going to get pushback from the NASDAQ. You're going to push back from all these people who have spent hundreds of millions of dollars, if not billions of dollars, to create a monopoly where their shares are traded on their exchange, and that's it. You want to buy Apple? You can't buy it elsewhere other than buying it through the NASDAQ, and they get a fee every time that's done. Right? That's part of their business. So I think that the digitization, the tokenization, as Andres points out, I think, I love it. MDB Doc says Dave Ramsey is yelling at the screen right now. Let him yell. I'd love to have him on. I'd love to have Dave Ramsey on and just talk about some things. I think as you look at the net effect of Dave Ramsey, he's done a lot of good, but I think he alienates a lot of people, and he's got some really curmudgeon opinions that I think are holding people back from achieving their financial goals and getting bigger and bigger and bigger. Okay. I'm getting sidetracked here. I apologize, but I love the discussion. I'm hoping you're finding it somewhat interesting. I know that most of you are very familiar with ETFs, and you're like, okay, this is old news. But there are a lot of people that just don't understand them. I'm trying to think of the next segue here. If you know someone who has an IRA and is in mutual funds, like I would talk to everybody I know and just ask them about their mutual funds. If they're in mutual funds, you got to find a way out. You're a captive prisoner, and most 401ks offer only mutual funds. However, for many of you, if you go to your HR department, and this may be a game changer for some people in the audience, if you go to your HR department and you say, hey, do we have a self-directed IRA? In many cases, self-directed 401k. In many cases, you do. They just don't tell you about it because it's a little bit of a risk to them. Here's why. If I'm an employer and I offer you just mutual funds, those are all long bias. You're only going to be buying and holding. You're only going to be buying stuff that is designed to go up over time. So I don't have that much liability in this case. However, if I allow you to self-direct and you go away from mutual funds and now you have an account where you can go and trade options and futures and you can trade ETFs, now all of a sudden, what happens if you go all in on SDS, right? SDS is double short the markets, and you're all in on SDS, and the market just keeps on rallying. All of a sudden, your 401k is evaporating, and you may actually be coming back to me threatening to sue me because I lost your 401k, even though you're the one that did it. That's one of the problems that I think when I chose to self-direct my 401k at my employer, I had to fill out a form acknowledging that I accepted the risk of it. But many of you have that possibility. They just haven't told you. Mark Simmons says, Dave Ramsey will take a person from an F grade to a B minus. If you get better than that, there are other ways to place them. Yep, I agree. And that's, I love the fact that he's really helping people out. I think he's helping people out that are in such dire financial straits, they got nowhere to go. Once you get past that obstacle and now you're okay, I've got my debt under control. I understand my consumption patterns. I know where my money's going each month. Then you have to look further. It's no longer like, how do I do damage control? And I think everybody here, I'm going to say 95, 99% of everybody here is in that category of, I got my personal stuff under control. I'm not worried about my credit score. I'm not worried about this. I'm up to here, planned out. Now it's like, how do I take and get to that A mark, that A+ mark? I totally agree with you, Mark. If you want to get better, I think Dave Ramsey limits you past a certain point. Favorite Ramsey quote: "Buying Bitcoin for $11,000 is stupid." Well, again, for when people don't understand something, they'll smash it. They'll badmouth it. And would I tell anyone here they should go all in on Bitcoin? Absolutely not. That'd be irresponsible of me. Should you have some portion of your portfolio in digital assets? I believe so. But if you don't believe that we're going through a financial revolution, then you're going to have the same opinion of Dave Ramsey, same opinion as Dave Ramsey, which is, it's a scam, it's a fraud, run away. Clearly he doesn't understand it, and he probably doesn't think we're going through a financial revolution. I do. I think we're going to see these financial markets evolve significantly over the next decade, and I hope I'm right because I'm positioned for it. Wire only money market? Yeah, that's a weird one, John. That one I don't know the answer to that one. His advice for people who have zero financial... Exactly. Yep. The people who call in are... You know what? By the way, just so you guys understand the way this whole system works, when I hosted my live radio show, so I was nationally syndicated for a while through OTA, and I took live calls. I took real calls that were unscripted. If you watch Jim Cramer, when his calls come in, let's do a poll right now. Let's see. Start a poll. When Cramer gets a live call, is it scripted? There you go. Start that poll right now. So when Jim Cramer or Dave Ramsey gets a call, Is it scripted, or is that actually a real person on the phone, unedited, unvetted, calling in and saying, "Hi, booyah, this is Merlin out in California. I'd like to know about Shabuzi stock." And Jim Cramer, without missing one beat, oh, Shabuzi stock, and he knows everything on earth about Shabuzi. I'm making up the name Shabuzi. These shows are scripted. So part of what I'm hoping I could accomplish, and I have no way of doing this, is I would actually love to get a pitch package to CNBC, Fox, Bloomberg, the major networks, which I shun. I don't like them because I think that they're scripted, printed, manipulated media. And what I wanted to do was actually do a live real show with no script. I don't want a teleprompter. I'm not reading cue cards. I want to do it live, real. And if I mess up on air like I do here all the time, so be it. The answer to this, guys, and there's people still answering the poll. I'm surprised we have 84%, only 84% says yes. Yeah, Margaret, you're right. Susie Orman and Dave Ramsey are booksellers. Now, they have some knowledge about the markets, but, at a certain point, it's about making tons of money. And I would love to have a show where it's actual real calls, real trading, live, unscripted. I would like the show to be called Financially Unscripted, and that's the show. All right, I'm going to end this poll here so you guys can all see it. Only a few of you voted. That's okay. 85% said yes, it's scripted. It is absolutely scripted, and the reason I know this is because John O'Donnell, when he was in New York, was on CNBC set, and he was one of the callers. They asked him, "You want to be a caller?" and gave him a little script. Here you go. Read this. Okay. Booyah! This is John out and, just making it all up. I listened to a couple episodes of Dave Ramsey, and when he has callers, there's no way that stuff is fresh off the top of his head. No way. Nope. Not going to happen. It would for me, though, because I can do that type of stuff. Let's see. Tom says, it seems like a lot of Ramsey's call-ins had a $100,000 mortgage and $100,000 toys they could sell. They always seem to be really dramatic, though. I think some of them are just so over the top. I don't think a lot of them are real, personally. I think some of those callers are absolutely fake, because I'm just thinking, how could you get yourself at that bad of a spot and have the stomach and stones to call Dave Ramsey? You screwed up. Why are you in it? Why can't we call you on the show? I don't have a line set up. We probably could set that up at some point in the future. Here's the real reason, Rob. I am trying to do so many things. All right, I've got 3 monitors. I'm doing mission control. I'm testing, make sure all my audio levels, all the stream runs smooth. I got to make sure that I'm clicking on the right windows. I've got a whole switching control panel. I'm working on an audio control panel for you guys. To deal with live calls is a totally different ball game. That I'd rather have somebody handle the calls and give me a cue, yep, Merlin, call on line 2. Maybe at some point. Yeah, Steve says, "Oh, Merlin, I know people that are in really bad shape. It's unfortunate. Wish we could help them all, but maybe you're right." Ramsey does it for the shock and awe. I agree, Oliver. And sometimes it is pretty shocking. I'll help for a beer. Well, let's see if I can get if anybody has an in at one of the major networks. I have been on CNBC. I've been on Bloomberg. I have been on Cheddar. And unfortunately, I am such a poor networker, I never got contact information at any of those places. What I really wanted to know is who is the staffing person for a CNBC or Fox or Bloomberg. I don't really care which station it is. Some of these guys some stations are kind of, some people hate them because of their political affiliation. I'm not going to have a political affiliation, so it's just going to be all about trading. But I would love to craft that show, and if I could get a team to do it with me, that would be the ideal way to do it. And the one reason that they have to do the scripted shows is you could easily get a call from somebody who hates you. You guys all know that there's an individual who I despise with all my heart. I think he's one of the worst people on the planet, out of Chicago. And that's the type of guy who would call and drop F-bombs on the show live. So you have to, that type of stuff, you got to vet him and get him out of there. Would I do BBC? Why wouldn't I? My British accent's no good, and I'm not very abreast of British markets, but absolutely I would do a show. I think that, what I really think is there should be a channel on something like Amazon Prime about, starting to do their own broadcasting and actual television shows. I don't know. I have all the ideas for this show well written down, and I would love to do it, but it's tough, man. It's tough getting your foot in the door. Only blood kissers get to be called in. Yeah, typically. What did Michael say? I'm going to go back here. They record all the shows. They do. All right, I think I've gone through the ETF thing quite a bit extensively. I did a bit too much on that one. Anyway, Chio, who's not here today, I hope that helped out understand a little bit. I'm a huge fan, and as was pointed out earlier, one of the reasons I love him is that's the foundation of my 1% strategy. I already showed you over here, when I'm going out and looking for potential trades on the 1% in my 1% accounts, which are 2 of them, I'm looking out here and checking, is there opportunity in any of these ETFs? In those 2 accounts, I'm not allowed to sell puts on individual securities. They have to be diversified so I can eliminate a lot of that risk. And I got lower fees on it. To me, it's just the way to go. So, yeah, I think ETFs are fantastic. Whether you're a long-term investor or even active trading, it smooths things out for you. And while you might get a better rate of return trading an individual stock, I think it's worth it to take some of that risk off the table by having an exchange-traded fund. So hopefully that helped you out there. You maybe need a name like Ponzi. Ed Ponzi? Yeah, he's got the name for it. I like Ed. Ed, I used to work with Ed. He's a nice guy. He wrote a couple books on Forex trading. It's funny, once he realized it had a small audience, though, I asked him to be on the show a couple times, and as soon as he realized there's a small audience, he just would never come on the show again. All right. Okay, let's run through our markets here real quick. Yesterday we had that talk about a hanging man formation on Bitcoin, and lo and behold, what did we get? Well, I'm sure Steve Nissen wants to be on the show and talk trash to me because it was a reversal. We had a pretty nice down day today, down 4.06% on B to the T to the C. This yellow box right here is now gone, in my opinion, because we broke through it. So now it's a question of where might we come back down to. Even though this is a very short move up here in Bitcoin, I'm kind of looking at, one second, draw your rectangle on there. I'm looking at right in here as that next stop, which it's pretty close, but that would be a good point for it to bounce, right? I like to see this one come down here and then bounce up to the top side and get a little more upside moving for Bitcoin again. I was talking about it in my crypto class this morning. I don't see a lot of reasons going forward that would cause Bitcoin to sell off. The only thing I could think would come out that would be potentially damning for it would be if SHA-256 gets cracked, if one of these accounts that's been dormant for 10, 12 years all of a sudden opens up and unloads their Bitcoin. I did not see much. There was an impact from what I thought was the Mt. Gox sellers, but it wasn't very much. Some people sold right away. You could kind of see on the price chart. And then we've been running ever since. So if the market's absorbing all that selling pressure of Bitcoin, not only from Mt. Gox, but also from the German central bank selling off their Bitcoin holdings, this is a really good sign looking at Bitcoin's price chart. So yeah, a little bit of a pullback here, and then I think we'll be challenging all-time highs here relatively soon. That was your worst performer. Crude oil. Oh, I was watching this one today. Did what I thought. It said if we're not going to bounce here, we're probably going to go and challenge this lower demand zone, which is going to be between 75.67 and 75.21, so a little 46-cent range there. That looks good. I would love to be a buyer of CL, and I'll probably do the ETFs. I'll probably be doing UCO or USO on that one as we get down to that level there. So we'll see what happens tomorrow. The 10-year didn't really do much today. You have the small little unchanged candle, so big ebb, no talk for us. Your NASDAQ 100. So we kind of closed right at those lows that were back from June. Bounced off it yesterday, a little bit of hesitation today, so I still don't think we're out of the woods yet with regards to a potential sell-off here. Remember, you had Tesla report earnings after hours today, and they're down 6% right now. Let me go up and bring my 5-minute time frame. Ba-boom. So Tesla selling off quite a bit right now, 6%, not the end of the world. We're right now at $230 per Tesla share, which just drives me nuts because I got out at 165. But anyway, we're literally right down at this blue line, which we're a little bit below that blue line right now, which is kind of the line in the sand that I had for Tesla. And if you look at Google, which is also down, remember these are some of the heavier ones in the NASDAQ 100. There you go. You have a little bit of a shooting star here on Google today. Boom, down 1.69% in the after-hour session. We're currently at 180, which would bring us right back into these lows we saw here from just a couple days ago on Google. Anything down below that, and I think you might be looking at more downside movement. So all in all, those two, the big names after hours reporting earnings. I'm almost at the top here. That was NASDAQ. S&P, I had 2 trades today. A nice winner and a small little loser. Fine. Again, it was all opening range stuff. You guys look at the intraday on S&P. You're open here. So I had a nice long on this open right in here, and then I actually closed it out and went short right here as we popped up, and unfortunately my stop loss was a little bit too tight. Took me out. It did what I thought it was going to do, but my stop loss was too tight and just took me out. So dab nabbit. Would have been two really nice trades, but instead I'll take the one, and one nice one and a little bit of a loser. Dollar index. There is your DXY. There you go. Dollar index on the day, continuing a slight move to the upside again. I don't think we're out of the woods here either. This picture here shows me lower highs, lower lows, at least slowly since April. So if we get above that 105.20 mark, my story might change, but we haven't broken a pivot or swing here at all. Move to number 2, gold, 0.53% off that bull trap we saw. I don't see any demand zone here that was causing this bounce, so just natural market forces here, up 0.53% on the day. And the Russell, your big gainer, man, everything's doing not the opposite, but just everything's choppy and erratic. I was expecting this to have a deeper pullback, but yesterday, getting some follow through on that run from yesterday, we were up today 1.04% on the Russell. All in all, looking pretty darn good. All right, so those are your earnings calendar numbers. Let's go to your economic calendar for tomorrow. The only thing that stood out for me today was this housing, existing home sales. Kind of felt with the dropping 30-year rate mortgage that we would see this actually get higher, but it's not. We actually saw a decline in existing home sales, went from 4.11 million to 3.89. Tomorrow's a big day, though. You have a lot of manufacturing and services numbers coming out. You've got France, you've got Germany, you've got the UK, you have the EU, then you have the United States. All those other ones I mentioned are before the market opens. Once the market opens, though, we do have manufacturing numbers, which are going to be 15 minutes into the trading day for the US. You also have a rate announcement for Canada at that exact time. Right now, 25 basis points is what they're expecting that cut to be. And then you also have a couple FOMC members speaking tomorrow, so a pretty busy day. Of course, I think all eyes will be on President Biden tomorrow and seeing what he says at his speech, but that's going to be in the evening at 5 p.m. Pacific time tomorrow, giving an address about current market conditions and his current condition with Mr. Biden. All right, where was my earnings calendar? I had it on here. Let me bring up the earnings calendar for you guys so I can have that one, and we'll go through your earnings for tomorrow, and I can wrap up this show. It is hot up here today. All right, here is your earnings calendar for mañana. A lot of big names. AT&T, Ford, IBM, one of the bigger names on that list. Those are your big daddies. I'll click on by market cap. You've got Thermo Fisher as well. Okay. Next Era Energy as well. Boston Scientific. Gotta love them robots. KLA Tencor, General Dynamics, Waste Management, and a few others. So should be a pretty busy day for mañana. It's going to be a good one. I think it's going to be a fun one. Michael says, what's the difference between USO and UCO? So here's USO. This is a U.S. oil fund. If you look at UCO, you're talking a leverage long. So this is a double long. This is a 2X fund. So typically, let's just look at the sell-off that's happened since July to where we are right now. This one's down 14.25% for UCO. USO statistically, should be about half that, 7.24. So all it is, Michael, this is USO considered a single, and UCO is a double. So if we get down on crude oil and get down into a demand zone that I like tomorrow or the next day down here on this picture I'm showing you here, I'll be looking at, depends how confident I feel. If I feel really confident, I'll go long UCO. If I'm just kind of taking a shot at it and like, not so sure, I will do USO. But if I'm really confident, I might go into the doubles, but I'll let you guys know when that happens. Remember, it's a big if we get down to that lower level on crude oil. All right. Well, I hope you enjoyed today's show. It was a little bit different, more education than anything today. Hopefully, Chio will watch these shows. Yeah, Chio's calling David. Hopefully, Chio will watch this one and give me some feedback on it. But for those who might be new, if you have family or friends that don't understand about exchange-traded funds, or they are on a retirement account stuck in mutual funds, you might want to clue them into this show. I'm going to change the title. It's just all you ever wanted to know about ETFs. And granted, there's definitely much more we could talk about. I did not get into the double, the triple leveraged ETFs, but you have ETFs for just about everything. Tom here says, you prompted me to look. There is a triple X SPX fund warms my FNGU heart. So Tom's always been a lover of FNGU. So FNGU, and this, I think FNGD is the other one. These are triple leveraged ETFs, guys. Be careful. If you are jumping onto a trend that's moving and you feel like there's a great trend going, then these can be very good. But if you're, or it's just short-term day trading, these funds, the longer you hold them, the more dangerous they are. The longer you hold them, the more dangerous they become. They will doesn't matter what the market does, they will start to lose a piece of their value over time because of how they are calculated in that index. And the leverage part of it is what makes it even worse. So be careful on these triple leverage longs. When I was teaching back in 2000 and, I think it was 2005, I had a class, maybe 6. I had a class in Irvine, and there was a guy that all week he kept talking about FAS and FAZ. Are they still even there? FAS, FAZ? I haven't traded them in years. FAS. Yep, this is triple financials, triple long financials. FAZ is triple short financials. This guy was trading these ones. I forgot what it was at the time, but it was like I think he had he was long FAZ, which is triple short, and the market just kept rallying and just evaporated his account. And one day he just left. He just disappeared out of class. But look at the chart, right? This does nothing but go down. It's literally designed to go down. Some markets are designed to go up. These are designed to go down. They're built to go down over time. You look back here, all-time high for this bad boy was up at $6 million, over almost $7 million a share back in 2008. Yeah. I mean, really, if you think about it, all you'd have to do is short a triple leveraged ETF. Over time, they'll have the same basic picture. Anyway, I'll stop right there. Yeah, Jamie, we'll talk about we'll talk about the ETF approval on tomorrow's show for Ethereum. That's another big one. Do you like any of the earnings? Because I was thinking GM was good earnings and they didn't guide up. No, I'm not really a big fan of earnings. No, I don't follow them too much. I like to watch when they come out. Oops, sorry, the GM. But no, I'm not a big earnings fan. I think earnings are lies. I think earnings are manipulated. The thing that's not lying to me, Michael, is price. At this point, I actually would, if you're looking at this price chart right now, I would look at GM and say, I'm okay buying it. Look at the long. You pulled back into a demand zone, so that's pretty much it. All right. Michael's going to... Oh, Kenny. All right, guys, that's going to do it for me. I got to run. Thank you. Hope you enjoyed today's show. Something a little bit different. Again, I try to steer towards what you guys would be interested in. If you have a topic you want me to cover, let me know. TraderMerlin@gmail.com, or put your comments down below any of the YouTube videos. I will put them on the slides, and I'll get to those on tomorrow's show. Have a great day, everybody. See you tomorrow.